John, maybe you can summarize for investors why they should own gold. Why should it be a part of their portfolio?
Yeah, I mean, we've been huge proponents of gold, obviously, at Sprott for many decades. And we view it as not a commodity, but as a financial asset, as an alternative currency. And we think it plays an important role in a portfolio in terms of acting as potential insurance or ballast to offset the risks of different asset classes like stocks.
John, gold was one of the top performing metals in 2024. It was up approximately 25%. And with this move in gold, I'm curious how the flows were into the Sprott Physical Gold Trust.
Yeah, well, last year was about 400 million US dollars came into the Sprott Physical Gold Trust, which is obviously an enormous amount of money. But relative to the performance of gold last year, we were actually a little disappointed with that. We thought there would be more investor interest in gold. And I think it was really because of other asset classes performing very well, things like tech stocks and Magnificent Seven stocks. I think they obviously diverted a lot of the attention away from gold amongst some investor groups, but that's a really good performance for gold. And I think the flows, we shouldn't be disappointed with that, because I think gold is going to continue to be quite strong in the next few years.
And the gold trust is the largest now in the Sprott family?
Yeah, it's our flagship fund. I mean, it's coming up to 15 years in age, and it's about 8.6 billion US dollars in size. It's one of the largest in the world, and we're incredibly proud of its success and all of the metal that we've been storing on behalf of thousands of investors around the world.
And silver also had a good run in 2024. It slightly outperformed gold. What were the flows like into the Sprott Physical Silver Trust?
Yeah, a little over 300 million US dollars came into the Silver Trust. I mean, the one thing about silver that everyone has been waiting for is for it to get back to its 2010 high. And we're still quite a bit away from reaching around $50 an ounce, right now sitting around 30. So we think there is still a lot of opportunity for that to reach its highs back in 2010.
Now, in spite of the moves that we saw in the underlying commodities, we really haven't seen a corresponding move in the equities. And if you look at Newmont, for example, the world's largest gold producer, it was actually down on the year. And if you look at Agnico, the third largest gold producer in the world, it was up about 30% on the year. Why do you think we're seeing such a huge disparity in terms of the performance of the equities, in spite of the move that we're seeing in the underlying commodity?
Yeah, it was a very mixed and challenging year for the gold equities. Some equities did reasonably well. Some of the smaller cap names in particularly did better than their larger cap counterparts. But as you said, some of the bellwether, the largest gold miners in the world, struggled last year. I mean, Newmont, obviously, and Barrick as well, underperformed gold quite significantly. And I think that's very confusing for a lot of investors, because the reason that you invest in gold stocks is for their operating leverage. As the price of gold goes up, you would expect a big chunk of that to flow down to their bottom line. And that clearly is not happening universally. Some of it is driven by operating challenges, cost overruns. Some of it is geopolitical reasons. In certain countries where mines are located, they're having challenges with local governments. Resource nationalism is on the rise. We're seeing that in parts of West Africa in particular, and that's obviously had a huge impact on the performance of some of those individual gold stocks last year.
And when you look at the buyers, the gold and silver products, how would you characterize those buyers? Are they institutional, retail?
It's everything. I mean, gold is really a universal asset class, and our funds, being exchange traded, are really accessible to just about any type of investor as long as they can access that particular exchange. We've seen growing institutional interest in our products in the last few years. That is a big change in the last 3 years, I would say. More and more investors, I think, are starting to realize the importance of having physical metals in their portfolios again after largely ignoring them from, I'd say, 2011 to 2020. This is starting to come back. And it's important because when you look at how much exposure institutional investors have to precious metals, it's really tiny in aggregate. And many institutions have zero exposure. So it doesn't take a lot of capital to start shifting around for that to have an impact on flows and obviously the asset prices themselves.
Yes, and you raise a very good point. One of the things that I read recently was the amount of gold held by central banks. They've been big buyers in the last couple of years, consuming or acquiring 25% of global production, 25% of global production. But all the gold held by central banks in the world only adds up to $3 trillion, which is the market cap of many tech stocks in the US right now. So I am surprised there hasn't been more interest, not only from central banks, but from institutional investors.
Yeah, I think 2024 was the year of the central bank buying gold. I think they had the single biggest impact on the gold price and the flows. It wasn't just China. Everyone talks about how China are basically recycling their US dollars and US treasuries into hard assets like gold. There's a very interesting chart you can look at in terms of looking at the holdings of US treasuries by the Chinese government and their holdings of gold. It's basically a mirror image, one going down, one going up. And we think that recycling trend is going to happen for a long time. And yes, China will try to talk the price of gold down when it gets a little bit too hot in its minds, but we think that that's not going to be effective and that they're going to be steady buyers of gold longer term. It's not just the Chinese central bank. We've seen the Indian central bank, the Turkish, the Singaporean, the Polish. They've all been buying large quantities of gold. And this is really, I think, part of a shift in their foreign exchange reserves. They're moving away from paper currencies and they're adding more hard currency, which is gold. And we think this is part of this kind of bipolarization of the world that's happening. Geopolitical risks are changing, and we think it's going to favor gold longer term. In sharp contrast, when you look at gold ETFs, which are a good barometer of institutional interest, they were in net outflows for the fourth consecutive year last year. So even though the price of gold has appreciated meaningfully last year, institutional investors, we think, were net sellers. So all you need to do is have some of that institutional buying power come back into the gold market, and you can have a very, I think, powerful set of buyers all moving in the right direction.
And you just mentioned that you think institutions were net sellers of gold. And we did see the price of gold fall off after the US election in November. Why do you think that was the case?
Yeah, well, leading up to the election, there was a lot of uncertainty in the market in terms of who was going to win. Everybody thought it was going to be very close. In the end, it didn't. And we think there was a lot of pre-election positioning, both in the futures market and the physical market, but mostly in the futures market. When the election outcome was concluded, we think a lot of that was unwound. We saw some unwinding of those positions. There was also some euphoria that lifted stocks and cryptocurrencies around Trump's, pro-business stance, low taxes. But a little bit of that has kind of worn off, reality setting in. Now there's growing anxiety about trade wars, tariffs, currency depreciations, ballooning debt, deficits, interest payments. And I think you're starting to see gold, kind of reassert itself here a bit as people, I think, are viewing some of the geopolitical and macroeconomic risk factors in a different light.
You just touched on inflation, and Stanley Druckenmiller, a well-known U.S. investor, has said one of his biggest threats he sees in 2025 is a reacceleration of inflation. And one of the things he cited was lower taxes, higher tariffs, and he thinks that's going to be inflationary. What are your thoughts on that, and what will higher inflation or a reignition or a reacceleration inflation due to the price of gold?
Yeah, last year we obviously had the Federal Reserve cut interest rates a number of times on the back of inflation slowing down. And it's interesting that since the last interest rate cut, the US Treasury yield has gone nowhere but up, which is very counterintuitive. If the Fed is in an easing mode, why are longer term bond yields going up? And it's because the bond market is concerned about everything you just outlined. They want to be paid for what they believe will be higher inflation, whether that comes from the deficits that are out of control or tariffs and the inherent inflation that will import into the United States. The bond market is basically, I think, a pretty strong barometer of what expectations are. And now I think expectations are that the Fed is not going to be cutting as many times as previously thought in 2025. Higher interest rates are also very inflationary. If you think about things like mortgage interest and other consumer debt, if rates stay high, that's obviously not going to help inflation either.
And because the 10-year has moved quite high in the last few months. It's gone from a low of 360 up to 450, 460. The US dollar has also caught a bit, and this is negative for gold. But gold's been hanging in relatively well.
Yeah, I think you raise a really good point that in spite of higher treasury yields and a strong US dollar, gold has been very resilient. And I think it's because gold is simply reasserting itself as a financial and monetary asset. It's being sought by central banks around the world. It's also being sought by a number of investors around the world that are increasingly, I think, concerned about holding their own local currencies or assets. I think China's a really good case study. China is a country, obviously, of huge savers. And if you think about the types of options that Chinese investors have to put their capital into different asset classes, a lot of them don't look very attractive right now. The real estate market is going through a 2008 type of reset like we had in North America. Their stock market has been under pressure for years. And so that leaves gold. And that's something that they have a lot of history and affinity with. And we see continued buying by Chinese investors into gold products.
You just touched on China, second largest economy in the world, representing 20% of global GDP. So what happens there has a big impact on the rest of the world. It is definitely slowing down. Europe is slowing down. We still have pretty good growth in the US, growing at 2.5% to 3%. But if we get a slowdown in the US for whatever reason, what would this slowdown in the global economy mean to the gold price?
Yeah, I think it'll be resilient, because I think what will ultimately drive the gold price is the current scope of buying that we're seeing in the market, which is very central bank driven. And central banks are not as sensitive as investors in terms of the price of gold, meaning if they have a policy objective of X% of their reserves in gold, they're just going to buy gold at whatever price until they reach that objective. So I think gold is more insulated against some of those shocks. But going back to your comment about China, it is weighing on, I think, a lot of investors today. And the Chinese economy, which for years grew at 7 or 8% per annum, now we're talking about 4 or 5% at most. And that is weighing on, I think, a lot of investor sentiment, because it is such a big economy and it is very important to a lot of different metals, given how many metals they consume and how many, the high percentage of metals that they obviously process in country. And I think that's had the greatest impact on metal markets in the last few months, this anxiety about whether the Chinese economy is going to shake off its situation. Government stimulus doesn't seem to be changing sentiment, and I think a lot of people are taking a wait and see approach there.
And John, maybe you can summarize for investors why they should own gold. Why should it be a part of their portfolio?
Yeah, I mean, we've been huge proponents of gold, obviously, at Sprott for many decades. And we view it as not a commodity, but as a financial asset, as an alternative currency. And we think it plays an important role in a portfolio in terms of acting as potential insurance or ballast to offset the risks of different asset classes like stocks. And one of the things you notice about bonds right now is it's not really playing that offsetting hedge right now with equities, because bond yields are going up, which means bond prices are going down. So we think that gold could be a more effective hedge than bonds right now, given the very high levels of debt and the growing anxiety about inflation right now. So it should be the cornerstone of a portfolio. It should be a strategic asset allocation. We don't think it's an asset that you should try to time. It should just sit there and accumulate, value over time, which is what it historically has done. And we haven't advocated to people to put a huge amount of their portfolio into gold, but we think it should be a small part of your portfolio to complement the other more risky assets that you may own.
And Sprott has done a great job in creating a lot of resources for investors to learn about gold, silver, and various other metals. And if they want to access this information, where do they go?
Yeah, I mean, our website has a ton of content that our market strategists and portfolio managers write and blog about every month. We've got a great podcast. We bring in a lot of special guests, which are subject matter experts. And we're huge believers and proponents of investor education, which is why we do all these events and spend so much of our time, writing and talking to people. So I would encourage people to come to the website, go to our insight section, go to our blog section, and start your learning journey there.
John, thank you very much for telling us all about Sprott and its various gold and silver products.
Thanks for having me. It was great chatting.